Welcome to today's video. In project management, choosing the right project often means examining all the costs and benefits involved. One key concept that sometimes gets overlooked is depreciation. In this video, we're going to break down what depreciation is, why it's important for project selection, and use a real-world example to make everything crystal clear. Let's get started. Depreciation is an accounting method used to allocate the cost of a tangible asset over its useful life. Imagine you buy an expensive piece of equipment. Over time, as it gets used, its value drops due to wear, tear, and even technological changes. Instead of taking the full expense in the year of purchase, depreciation spreads this cost over several years. This gives a more accurate picture of how much the asset is actually costing the business over time. There are several ways to calculate depreciation. The two most common methods include straight-line depreciation. This method spreads the cost evenly over the asset's useful life. For instance, if an asset costs $100,000 and you expect to use it for 10 years, you'd expense $10,000 per year. Accelerated depreciation. Methods like the double declining balance allow for higher depreciation in the earlier years. This is often used when an asset loses value more quickly when it's new, or when tax regulations offer greater benefits early on. Even though depreciation is a non-cash expense, it affects the cash flow by providing a tax shield. This tax benefit can improve the project's net cash flows and may influence the decision to select one project over another. Let's look at a concrete example. Imagine you work for a manufacturing company, ABC Manufacturing, and your team is deciding whether to invest in a new production machine. Initial investment, $100,000. Expected useful life, 5 years, residual value, salvage value, $10,000. Using the straight-line method, the annual depreciation expense is calculated as annual depreciation equals cost minus salvage value divided by useful life equals 100,000 minus 10,000 divided by 5 equals 18,000 per year. This annual depreciation of $18,000 reduces the company's taxable income, which in turn reduces the tax burden. When you're comparing projects, the tax savings generated through depreciation, known as the depreciation tax shield, can make the cash flows more attractive. The improved after-tax cash flows may be enough to tilt the scales in favor of investing in this new machine over other projects. In project selection, techniques such as net present value, NPV, or internal rate of return, IRR, often rely on accurate cash flow estimations. Remember, while depreciation isn't a direct cash expense, its tax benefits have a significant cash flow effect. For example, if you compare two projects where one has a high depreciation tax shield versus one with a lower shield, the project with the larger tax benefit might come out ahead in a cash flow analysis. This is why understanding depreciation is crucial. It ensures that your project evaluations consider all financial impacts. To sum up, here are the key takeaways. Depreciation allocates an asset's cost over its useful life, reflecting its gradual loss of value. Two major methods are the straight line and accelerated depreciation techniques. Despite being a non-cash charge, depreciation creates a tax shield that improves after-tax cash flows. In the context of project selection, these improved cash flows can be crucial when deciding between competing projects. By grasping these concepts, you're better equipped to evaluate projects holistically and make smarter investment decisions.